Now, folks, for our panel discussion on smart beta. And without any false modesty, let me say I believe we have three of the best possible people in the world to discuss the subject, and many more in the audience. First, let me introduce Chris Brightman, further to stage left, who is CIO of Research Affiliates. He has 3 decades of investment management experience in equities, fixed income, currency, and asset allocation. He has traded securities and derivatives, managed portfolios, supervised quantitative product development, and allocated assets to alternative strategies. Before joining Research Affiliates, Chris served as a board member of the Investment Fund for Foundations, otherwise known as TIF, vice chair of the Investment Advisory Committee for the Virginia Retirement System, VRS, CIO of the University of Virginia Investment Management Company, CIO of Strategic Investment Group, Director of Global Equity Strategy at UBS Asset Management, Senior Portfolio Manager at Brinson Partners, Vice President and Head of Asset Liability Management at Maryland National Bank, and Associate National Bank Examiner at the Comptroller of the Currency. Chris is a member of the CFA Institute and the CFA Society of Orange County, and received a BS in Finance for Virginia Tech and an MBA from Loyola University, Maryland. Chris, welcome. Today, yeah, why not? Today we also have Ron Kahn, immediately to Chris's left, Managing Director and Global Head of Scientific Equity Research for BlackRock. As most of you are surely well aware, BlackRock is the world's largest asset manager, aside from government agencies. Ron joined Barclays Global Investors, BGI, in 1998 and became a BlackRockian, is that a word, when BGI merged in 2009. He's a well-known expert on portfolio management and quantitative investing, having published numerous articles on investment management, and with Richard Grinold, author of Active Portfolio Management, Quantitative Theory and Applications. The two of them are the 2013 winners of the James R. Wharton Award, presented periodically by the CFA Institute to recognize individuals who have produced a body of research notable for its relevance and enduring value to investment professionals. He's a 2007 winner of the Bernstein-Fabozzi-Jacobs-Levy Award for Best Article in the Journal of Portfolio Management, and serves on the editorial advisory boards of the FAJ, the JPM, and the Journal of Investment Consulting. In the 2007 book, How I Became a Quant, includes his essay describing his transitions from physics to finance, and it's a great one. He teaches the equities half on the course International Equity and Currency Markets at Berkeley's Masters of Financial Engineering program. He earned an AB degree in physics, summa cum laude from Princeton, and a PhD in physics from Harvard. He was a postdoctoral fellow in physics at UC Berkeley. Welcome, Ronald. Immediately to Ron's left is Rob Shapiro, who's Vice President at State Street Global Advisors. Rob is a Senior Research Strategist in the Investment Solutions Group at SSGA. In this role, he provides analysis and research focusing on building custom multi-asset class solutions for institutional clients. Previously, Rob was a portfolio manager in the Enhanced Equity Group, where he focused on quantitative equity modeling. In that role, he constructed and managed SSGA's low volatility strategies. He's been publishing research on smart beta equity factors since at least 2008. Rob graduated from Brandeis with a BA in economics and received an MBA in finance from Bentley University. He's also earned the Chartered Financial Analyst and the Chartered Alternative Investment Analyst designations, is a member of the Boston Security Analyst Society, the CFA Institute, as well as Kaya. Welcome, Rob. So, gentlemen, in some sense, this might be seen by folks in the audience as a continuation of a debate that we began last year, in which a number of shots were fired. We'd like to continue, though. One of the challenges that we've had, not just in the last year, but over a longer horizon, is exactly what defines smart beta. In your own view, understanding that there can certainly be dramatic differences in the way you actually view smart beta. So, Rob, let me ask you to start by defining smart beta for us.
The most obvious industry definition is that it's getting exposure to factors in the most systematic, transparent, and inexpensive manner. That's pretty much it.
Okay, all right. That's one sentence, I think, so that's pretty good. That's more than the industry has resolved so far.
I'll leave more
okay.
definition for them.
Yeah, Ron?
So I would add a couple things. First, I'd say I wish there were a better name, but it is what it is. So I think of it as active management with some of the benefits of index investing and the benefits that Rob already mentioned of transparent, low cost, And in terms of what are smart beta factors, we tend to think of them as pervasive long-term factors that they would impact many, many securities and have pervasive returns. And usually there's reason to believe that the returns will continue in the future.
Okay, thank you. Chris?
I agree that smart beta is a technique for delivering returns to investors using simple, transparent, well-known sources of returns at low cost, thereby delivering the excess returns to the extent that they're available more to the end investor rather than the manager. I also agree with Ron that it is combining elements of active management, if you define passive as being the calculated index, with a lot of the advantages of indexing, namely simplicity, transparency, and low costs. As to whether we should characterize it as factor investing, I am kind of indifferent. In some sense, I think almost all smart beta strategies and perhaps much of active management can be characterized or analyzed as a set of factor exposures, either static or dynamic. But I don't know that that makes everything factor investing. You can explain the excess return of the equal weighted S&P 500 as a factor strategy, but I assure you that the folks at S&P, when they calculate the equal weighted S&P 500 index, are not manipulating factor loadings. They're simply rebalancing to the number 0.2. But so in some sense, you could call almost everything factor investing.
Mm-hmm. So the question I think that we should address right off the start, and everyone I think in the room probably is well aware of what some of the controversies are, but this is a little bit like quantitative Zumba. We're going to warm up with it. What is the current controversy in the literature and in practice around smart beta? And why don't we just call it active investing? Okay, Ron?
Well, I think it is active investing. So you know, following what Chris said, you know, these are strategies designed to outperform broad cap weighted indices. So, you know, by my definition, that's active. But I do think that it's a particular subset of active investing. So I think you can look at any investment strategy and you can say, well, how much of this is coming from static exposures to these smart beta factors, and what's the residual to that? And I think that's a useful distinction to make. It came up in the last presentation, actually, that, you know, how much of what active institutional managers are doing is just delivering these factor exposures. I actually think there's a lot of value to be gotten from that pure alpha return beyond that. But that's something that's still hard to come by, low capacity, high cost, but valuable.
How can that possibly be controversial?
Well, I mean, I think that the smart beta name, the beta portion of it is based on the fact that it's systematic. And you know, a lot of people talk about beta exposure to fixed income securities. So this is why a lot of people are using the word beta. And then obviously the creators of the term smart beta think that that a lot of the quantitative active factors that people use is a smart way of investing. So
so the distinction among equity smart beta versus other asset classes is a key thing to key on here, or a key thing to highlight here.
Right. But they use the word smart, the creator of the term smart beta, because, you know, they think quantitative managers, you know, which a lot of us do in this room, think that quantitative managers have great factors that outperform the market. So that's why they use the word smart and beta. We obviously, at SSGA, we obviously do not agree with the name smart beta either. We manage a lot of passive investing, so we think people who invest passively are also very smart.
With a capital beta. Hey, Chris? What's your view?
Well, we like to say before there was smart beta, there was something called the fundamental index. My partners published the paper, the fundamental index, in the Financial Analyst Journal well over about a dozen years ago. And smart beta's name has been around about half that time. And there was a lot of controversy about the fundamental index. There was controversy from, interestingly, two different sources that were completely contradictory. There was the criticisms from the likes of Jack Bogle, by the way, a hero to many of us at Research Affiliates, who said that markets are efficient. You cannot have a simple, systematic way to outperform the market. This is voodoo, and it won't work. There were other people, equally vocal, that said, well, of course it works. This is just factor investing. You're combining things like value and momentum and small factors. And yes, it definitely works, but there's nothing new here. We all knew that you could outperform the market with simple factor exposures. Of course, those are completely contradictory, but this is a competitive business, and when somebody comes out with an innovation that attracts assets, you're going to receive some pushback from the people who might be losing those assets.
Okay, Ron, on innovation.
So I would add to this. I think part of the controversy over fundamental indexing, and I think it passes right into smart beta, is the idea of what does it mean to be an index? And when we think of these broad cap-weighted index strategies, as Bill Sharp taught us, those are going to be consistent second quartile performers just due to the arithmetic of active management. Right. So you can criticize cap-weighted indices, but they are consistent second quartile performers. And so then you look at these investment strategies, which may be, we can call them fundamental indices, they may be transparent and simple, but they're active strategies, and even if we believe they're top quartile performers on average over long periods of time, there's nothing that doesn't say that in any 1 year or period of time, they're not fourth quartile performers. So I think they have, there's a sense, whether we call it beta or indices, that they somehow share in that, they're going to be consistent performers, and I think what they can deliver is good performance over time, but much less consistent second quartile performance that a broad cap-weighted index would.
Do you mind if I build on that a little bit?
Please jump in, yeah. And if I have to separate you, I will, but please go ahead.
I strongly believe that these strategies can outperform over time. And perhaps a top quartile is a reasonable expectation, given what we know about the average in active management. And I think there remains a strong place for the passive index because, unfortunately, when we look at what investors actually do instead of what prescriptively we suggest they should do, is they have a performance-chasing style of selecting active managers. So this last paper that we talked about uses, as almost everybody does in the industry, dollar-weighted returns. The managers aren't responsible for the inflows and the outflows into their strategies, but we have access to the time-weighted returns. Jason Su, my partner, just published in the Journal of Portfolio Management an article that looks at what do investors receive in value funds. Value funds over time have outperformed the market. But the investors in the value funds have underperformed the market because they get in after 2 or 3 years of good performance, and then they get out after 2 or 3 years of bad performance, and their timing is so bad, and this includes institutions, their timing is so bad that they offset more than all of that return. So if you're not a well-informed investor that understands what you're doing and you're inclined to chase after the latest shiny object, including the factor that has performed the best over the last 2 or 3 years, you could end up investing in top quartile strategies and underperforming the cap-weighted index. And for those investors, which probably is a majority of investors, they might be better off in the cap-weighted index and paying the lowest fees.
Right, so the compelling math of consistent second quartile performance is something that Howard Marks, whom some of you know, likes to highlight as being really in the top 2 or 3% of performance over 30 years. Whereas occasional top quartile performance may be good for raising assets in some environments, but may not be best for investors in the long run. Isn't this really, in some sense, this discussion about smart beta, a question about how much non-benchmark risk is in the portfolio or in the sleeve that's being allocated to? And then, isn't this really then devolving to a conversation about off-benchmark risk, residual risk, and the spoonful of sugar that helps the medicine go down? Is it really new in any way?
I think it is new, and the paper we just heard says it's new. What's new is using the technology that's available today to deliver these strategies at far lower fees and with more transparency. That's the new part, the transparency and the lower fees.
But why call it beta, I guess, is another way of saying the same question.
It's systematic is really the reason.
It's mechanical.
It's mechanical, and that's. It doesn't, it's certainly not beta,
But I think also, consistent with the last paper and a paper I recently had in the FHA, I think smart beta is a disruptive innovation for active management, but it's not the ideas aren't innovative in that they've been around for like 100 years or, more or less. But this packaging and pricing is really disruptive.
So smart beta is what we all have known since 1970.
Also, this idea that it's not beta, I want to just push back on that a little bit, right? If we believe that beta is a single beta from the capital asset pricing model, yes, it's not beta. But the predictions of the capital asset pricing model were sort of invalidated, I don't know, in the 1980s. And once we go to an APT construct where there's not a single factor, but there's multiple factors, then we're right back to factor investing, and this is beta. It's just a collection of betas. You properly specify your factor model, and there's no alphas left. It's not alpha investing, it's beta investing.
And we'll hear Bill's perspective, I suspect, at least a little bit later on this one. But the notion of risk sharing has got to be a part of the model then, behind the scenes. Because if these really are systematic, there's someone who's getting paid to hold the risk. And so
now you're coming back to that other controversy, which is it an efficient market where you're getting paid a risk premium to hold the factors, or is it a behavioral explanation? And I don't think we'll solve that today. I sit in the behavioral camp, but I acknowledge that I'm not going to be able to write an equation and perform an empirical study that's going to convince those that are in the risk camp.
Does it matter to you guys, as folks who have feet firmly in the real world, whether it's a behavioral anomaly or it's something like a risk factor? Does it matter to you if it's an alpha or beta?
I don't. To me, the only thing that matters is there a reason to believe this will outperform going forward? And so for us, we think some are risk factors, some are behavioral anomalies. At least one is a structural impediment. Which is how I think of the minimum variance anomaly, so you could. The only thing you could say is, well, if it's a risk premium, it'll always be a risk premium. If it's a behavioral anomaly, you could make the argument, not that I would believe it, but that human behavior could change, people could start understanding this better, so maybe it would lessen. But I think all of those things are still reasonably good reasons to think that these will outperform going forward.
Yeah, but it goes on beyond a philosophical question, right? Because if you're betting on what we would sort of casually call a beta, there's some kind of economic function behind it. There's a risk sharing or a risk premium bearing, a risk bearing notion for which you get paid. If you're betting on an alpha, you're betting on what Wes Gray highlighted earlier, which was not just the anomaly, but also what is part of a joint hypothesis notion of the impediment to the arbitrage. So must investors not think about that, Rob?
I think as quants, a lot of people are putting these factors in their models, and they believe that including these in the models is adding alpha, or timing between these factors is adding alpha. So in this room, the quantitative people who are not believers of the CAPM and who believe they can outperform the market believe that it's alpha.
Okay. Now, in a couple seconds, we're going to open it up to your questions, and so I hope we can get some of those prepared. Let us talk for a second about how crowded it's getting in the common tilts. And it came up a couple times earlier today, but let me ask you guys to comment on whether we are, once again, getting very crowded in the trades that are not necessarily different from what we saw starting in the third week of July 2007, carrying through the second week in August. Are we setting ourselves up for a kind of quant crash again?
I mean, we do have a model that takes a look at the book-to-price value of the best rated stocks versus the lowest rated stocks in 4 factors. We look at low vol, small size, value tilted, and quality. And based on our analysis, low vol is getting a little bit more expensive than usual, but it's not an extreme event. We still feel like all 4 of the factors are not crowded.
Not crowded at all. Tradable, accessible
Right.
by large pools.
But in some ways, some of them are going in that direction, and maybe in a few months, we may see them as being crowded.
After this conference? Yeah. Okay. All right, Ron?
I would just say, I wouldn't disagree with that. I would just say that if I think back to August 2007, there was probably a lot more leverage behind some of the quant factors. That I don't think there's a lot of leverage that you're seeing in these factors at this point.
So trades are not crowded. Ample room for growth.
Well, they might be crowded. There might be some pullback, but it's less likely to be as eventful as it was in August 2007.
Okay.
And although low volatility is talked about a lot, there's only about 3% of all assets are in low volatility strategies, so it's a pretty small amount. Versus value has about 35% of assets, including fundamental and different kind of value portfolios.
And that, I guess your point is also that that's not a risk-based allocation number, which is probably even lower. Right. That's low vol. Okay. Chris?
I think events like August 2007 are easier to identify ex post than they are ahead of time. So we may not.
I suspect about half the room agrees with you.
And I would emphasize Robert's point, and I think Ron agreed, there are some factor strategies that are getting expensive. Low volatility, also profitability. And it really, I would think it's you can put these all in the quality bucket. We've had a flight to quality that is a very large flight to quality. First, we had the global financial crisis. Of course, lower volatility, higher quality companies had lower drawdowns than value stocks during the financial crisis. And what have we seen is just sort of a rolling set of crises. Next, we had the Euro crisis and the Greek drama, and now the emerging market problems. And predictably with not just equities, we've had a currency flight to quality with the appreciation of the dollar, the Swiss franc, the yen. Developed market government bonds, if you're a safe country, are now at negative nominal yields. And investors are searching for stocks that act like bonds to get some yield in the portfolio, and they've pushed up the prices of profitability and low volatility. Is it dangerous? I think that's hard to judge. You could just say that they have gotten to be more expensive than they typically are, and they seem to be getting continually more expensive as investors grasp for more and more risk to get the yield that they need. I don't know how it ends.
So does that mean expenses will come down? And this, I'm not asking you to make an offer.
I think smart beta is going to cause expenses to come down.
In a continuing, in an ongoing way. There's no question.
Fees are under pressure.
Across the board? Yeah, okay. All right, let us start to open it up for questions from this beautiful-looking crowd.
So whatever panelist or Chris wants to take this, do you guys think there's an underappreciation? I mean, when you think of this ongoing continuum of alpha, beta, exotic beta, and it's really, like I think you guys have pointed out, it's sort of a packaging and a product development, not necessarily innovations that are embedded in there. So you start thinking about the products that are out there. Is there an underappreciation for what is truly embedded in common products? So I'll give you 2 examples of things that you guys brought up. Low vol, right? And in low vol portfolios, if it's just buy low vol stocks and and sell high vol stocks. There could be value in there. There could be sector bets in there. So I think certain providers might orthogonalize to those and some might not. And so it's not homogeneous. And of course, over points in time, you might get hit by buying expensive stocks. Or take you guys didn't talk about exotic beta, but let's say you have a momentum-based factor on currencies, right? And you're asking if it's getting crowded. At some time, you might say, well, you said the quants are smaller or whatever, but if you look at, especially at the end of last year, the quote-unquote crowded dollar trade, there was quants that were trading on momentum that got long dollar, short euro, and then there was a lot of fundamental discretionary guys that said the Fed's raising rates and the ECB's lowering rates, so therefore I want to get on the same side of that trade. So these are things that, when you talk about sort of the terms beta, it seems like there's sort of a concept, whether you want to use CAPM explicit beta or just systematic factors, that the smart beta stuff has other betas in there, quite frankly. I mean, that's sort of a statement and a question. What do you guys think about that?
Well, so the question is really about the purity of the tilts. And the industry, of course. We're selling products, so there's a lot of different stuff out there.
Yeah, I think to Ray's point, one very interesting thing that I've thought about is to what extent do investors understand this, which I guess is your point. But the way I think about it is when it came to buying cap-weighted indexing, you can, let's say you want to buy U.S. large cap, you can buy the S&P 500, you can buy the Russell 1000, and I think people understand that there's there are subtle differences between those two. They won't have exactly the same returns. They'll be close, they won't be exactly the same. Here, I think when people are buying smart beta products, and even if they're buying value or value plus momentum, there's so many different ways you can define that. I think there's room for a lot of investor disappointment, which is maybe not your point, but it's just that there may be a large dispersion in returns to smart beta products that describe themselves almost identically, that we're giving you value, or we're giving you value plus momentum. There are just so many different ways of defining that ex ante are all reasonable, but ex post are going to give different returns.
I think it's very important that investors understand the strategies they invest in before they invest in them. And to take a point that you made, low volatility strategies. I think most of the low volatility strategies out there do not capitalization weight the securities. They use something other than capitalization weighting, whether 1 over volatility for S&P or some optimized weight like a minimum variance or a maximum diversification portfolio. Common to all of them is rebalancing. And a rebalancing strategy creates a dynamic value exposure. It's not static, it's dynamic, and the dynamic element adds value above and beyond the static value exposure. And so a good portion of the return of the products out there called low volatility strategies is dynamic value exposure from rebalancing. It's probably useful to understand that if you're going to invest in the strategy.
It's also important for the value portfolios right now. You do have an oil bet, and I'm sure, hopefully a lot of investors will understand that when you invest in a value portfolio right now, you're going to be overweight energy stocks and financial stocks that have been beaten down by the oil.
Unless you sector neutralize.
Right.
And so that's another part of the question. I'm just going to follow up on your question.
Yeah, I was just going to say that, like some of your competitors might sector neutralize that, right? So then you're going to, as Ron said, you're going to get dispersion. Like there's this concept that the beta providers, because of the term beta, are going to be pretty tight relative to some concept. And then you're inevitably going to see some dispersion. Just devils are in the details in how you construct the portfolio, right?
And don't most products make a couple tilts? Like you said, valid, equality, momentum, as opposed, I remember the fundamental Jacobs and Levy paper, disentangling 25 different effects. Why 3? Why not all 25? And aren't we loading up on something that could end up hurting investors?
I don't think there are probably 25 factors. It's probably more parsimonious than that.
More parsimonious?
And I think the industry is going more towards multi-factor solutions. So I think now you see, as this has developed, people have tried a lot of things, but I think that's where we're headed.
It's a way of life. Okay. All right. There was a question there. Yeah, gentlemen. Yeah.
a slightly related question. So there's any number of smart beta ETFs out there that call themselves value. Most of them are just value. I understand that some of them might be value and something else. Almost none of them, as far as I'm aware, are constructed in a way that is likely to maximize the exposure to value and ensure in any sense that most of the return that you get from the ETF is actually the value risk premium. Why is that?
People like long-only products.
So what? You could still optimize. I mean, if you build an equal-weighted ETF or a cap-weighted ETF or an attribute-weighted ETF, it's going to have an exposure to value, but it's not going to be as big an exposure as it could be, nor are the other exposures to other things that be minimized in any sense. Why does no one create optimized ETFs?
The optimization is tricky. One of the questions you need to answer if you're going to use optimization in a product design is how do you measure transaction cost, how many assets are going to be in the strategy, because the optimal strategy for a $50 million ETF is a very different answer than the optimal strategy for a $5 billion ETF. And so often the heuristics have a good There are reasons why simple heuristic strategies are more popular in the market than more complicated optimized strategies.
What about incentives? Why wouldn't you neutralize the big betas and apply a little bit of leverage and charge 2 and 20 or 1 and 10 or something higher than, say, 70 or 90 basis points? Why are we charging investors a huge amount of money for the big beta, the traditional beta? Is it because they'll buy it, or is it because of external reasons like the rebalancing issues you just mentioned? Rob?
The reason why well, at SSGA, it is kind of a marketing strategy for us, because a lot of clients are not going to come to us and look for very concentrated portfolios. We actually do offer concentrated portfolios in the different factors for any clients who might be interested. But for ETFs, we're more of a passive type of company. So companies, institutions would come to us for something similar to, a tilted strategy away from the passive benchmark. But we do, like I said, we do offer concentrated portfolios. We will charge higher fees. It won't be 2 and 20. So we do offer that product, though.
Oh, you do. But you're responding to demand, right?
Maybe I didn't understand the question, but it seems like I don't think anybody really can get away going forward charging 2 and 20 for smart beta funds, even if you're running them long short with leverage.
But charge something more relevant for investors than what they can get for 1 basis point for a reasonably sized portfolio, or a few basis points. Or they can buy a futures contract.
But I think it's there. The marketplace has very simple heuristic strategies that deliver factor-based excess returns relative to the capitalization-weighted market for a handful of basis points. And there are factor-based strategies that are long and short and use leverage that probably are, 100 basis points instead of 2 and 20 that deliver you many of the same returns that the 2 and 20 guys deliver.
But the products that have raised the most money that have been around longest are long beta, long equity beta, long duration.
Well, in some ways that's definitional. The capacity of the levered long-short strategies is quite low. They can't take in as much money as a simple heuristic beta strategy.
Yeah, and I think you'll see the development of offering of more of these strategies, but Chris is exactly right. I mean, you're never going to see most of the assets there. They just don't have the capacity.
Right. Yeah. Okay, let's keep going. Questions from the audience. I saw other hands being raised.
Thank you. Jose Manchero from Bloomberg. Given the fact that these indices are constructed using more mechanical rules, then you pretty much know what's going to be going into the index and what's coming out. Do you see any risk of these the smart beta indices being front run, for example?
We spend a lot of time on that, and we are constantly innovating to ensure that the market impact is modest given the nature of the strategy and the assets that are deployed into it. And so I think anybody that has a large smart beta business has to pay careful attention to market impact, of which front running is one, but not by any means the only a source of potential market impact.
I think it's certainly something to worry about. I mean, we see people try to front run the Russell rebalance. So, why wouldn't they try to do this?
Rob, you have anything?
There are a lot of smart beta indices out there, and they are rebalancing. A lot of them are rebalancing at different periods of time too. So there is a diverse time of when these strategies rebalance. So, and I have noticed that we analyze a lot of portfolios that institutions have, and we have noticed that a lot of institutions actually have a negative exposure to value and a high vol exposure. So a lot of active managers out there are taking the opposite risk.
An interesting point is if we calculate the market impact that models predict for a cap-weighted index, it's enormous. And yet the market cap indices don't appear to suffer that market impact. Once the market understands that the liquidity is going to be demanded, the structure of the market evolves to provide that liquidity in a way that just does not allow a systematic front running.
Okay.
Thank
Questions?
you.
Thanks a lot, Chris. This is Manos Hatzakis, Merrill Lynch Chief Investment Office. Throughout the economic cycle, different factors work at different times. And so the question is, when you put together portfolios, or ETFs with many different factors, I'd like to hear your views on timing the factors. Thank you.
Okay, timing factors.
I would say time. It's one of these holy grail things. Like it would be fantastic if you could actually do it. It's not that ex post. Knowing exactly where you were in the cycle, it's easier to sort of figure out what would have been good to do than to figure it out on an ex ante basis. The only other thing I would say is sort of what I was saying before. If you look at manager returns and divide them between the static exposures to these factors plus the pure alpha piece, we've always put the timing of factors in the pure alpha piece because I think if you can do it well, that's a pretty rare skill and it's worth fully paying active fees for.
I'd say it's on the cutting edge of smart beta or factor investing to the extent that we can model the timing of factors and do it in a systematic, transparent process. We aspire to disintermediate those assets away from the high fee active management space into the smart beta space. It hasn't been done yet, but that doesn't mean it won't be done.
Yeah, there's no reason to believe that if a quantitative portfolio manager can time their quant factors, then certainly they should be able to time smart beta factors since they're very similar and they're highly correlated to a lot of the quantitative factors that are out there.
Yeah, but that was a conditional statement. What's your belief?
What I believe?
Yeah.
I don't know.
If you can do it, you should. Okay.
Right. Well, a lot of people in this room believe that they can time quantitative factors. We have, we do have a group that will time. We have quantitative active management, and they're actually, if a client comes in and says that they would like to time smart beta, we will actually have them, present to the client and show that they can use smart beta strategies and time between them.
So there's a belief in action.
My group is a little more of we have a slow-moving signal that just uses crowding as a measure.
They use crowding as a measure,
Yeah.
as a content
And
measure.
it's very slow-moving. Generally, we're equal weight the factors, but in an event where a factor is very expensive, which I said low vol is not very expensive right now, so we're still allocating to that. But
You equal capital weight or equal risk weight?
equal capital weight.
Equal capital.
On factor timing, Somebody once wrote a fabulous book on active management that talked about the importance of breadth.
Yeah. Who that was?
If you look at factor timing from the perspective of a single factor, you will quickly conclude that it's hopeless to create a product around timing the value factor. If you somehow are able to create in your portfolio construction methodology breadth across factors, if you were allocating across 36 factors, of course there aren't 36 factors, but perhaps if you think of large and small as slightly different in different countries and different sectors, it's perhaps practical to create enough breadth that you could do factor timing.
And is that on the docket? Okay. All right. Good. Let's keep going with the audience participation and questions and discussion. Yeah, can't quite see. Oh, sorry. Yeah, Cliff. Clifford.
Yeah, I'd like to give the distinguished panel an opportunity to talk about what they see in this sector over the next 3 to 5 years. What kind of innovation will you see? What kind of growth will you see in these assets?
Well, BlackRock has predicted that there'll be huge inflows into this area, and I would generally agree with that. I think there'll be some continuing product innovation. I think there'll be more long-short products. I don't know if this is industry standard nomenclature, but factor investing versus smart beta, where factor investing is more long-short and smart beta is long-only. But I think there's going to be a continual flow into this, and I think it'll play into the flows we've seen from active into passive. I think some of the flows from active are going to go into smart beta and factor strategies.
Bob?
We see a lot of growth. We're talking to a lot of institutions all the time about exposures. They're very interested in seeing how they're currently positioned. So what we do is we often look at their holdings and see if which way they're tilted. And we recommend for portfolios that have a low value or a low or high volatility exposure to move in that direction. And it seems like a lot of the institutions are very interested in making sure that their factor exposures are positioned in a way that we encourage.
There are a lot of flows moving into what's called smart beta or factor investing, and I think there will continue to be. It's a very large growth area. As for the future innovations, one will be factor timing. Another will be additional asset classes. We talk mostly about factor investing as applied to equities, but it can be done in bonds, it can be done in commodities, it can be done in currencies. Once you recognize that, another area of innovation in product design and product development will be exploiting the predictability of these factors across asset classes, across equities and rates and commodities and currencies and volatility, et cetera.
Is there a risk that those signals will be correlated across classes? So, for example, clustering of certain carry trades or momentum
Actually,
across
be
classes?
surprised at how little correlation there is. Yes, there is.
With liquidity, say? With runs on liquidity?
Well, once you study something and once you create a product and once assets flow to it, the market has this fascinatingly interesting way of evolving and changing. So you can always ask the question, how will the market be different than what we've studied in the past? Interesting question. But when we study the past, there has not been, say, strong correlation of momentum across different parts of the segments of the capital markets.
On the average day? On the average day as well as the extremes?
Well, we only look at daily data. I don't know about the tick data.
Okay. Yeah, okay. All right, let's keep going. Questions from the panel? Right down in front, Wes.
Wes Gray, I'm an architect. How do you guys view financial advisory, and do you see more or less intermediation in the future?
So let me just repeat the question. So the question was about financial advisory and the panelists' view on financial advisory. And the second part of the question?
It's just, do they view that that's going to get disintermediated?
I see.
Do they effectively do that role, or are they
I
also
see.
going to rely on?
Will advisors ultimately be disintermediated? Yeah, that came up in the Sirius XM111 conversation with Bill Sharp today, relating to, in fact, maybe robos and other arenas of disintermediation. Yep, okay, for the panel?
I think if you had a professor at the University of Chicago who believed in efficient markets study the restaurant industry, he would conclude that nobody should ever pay more than $20 for a meal, and that anybody that goes and pays $300 for a meal is hopelessly lost and is inefficient. Now, of course, I'm being unfair, but the point is, people, when you watch as a professional what people actually want from an investment advisor, it's much more than a mean variance portfolio, and it's much more than can be delivered, I think, by a robo-advisor within the next few decades. There's an element of client service and human interaction that people crave and are willing to pay a considerable fee for, and it's not just the retail investor either. Many institutional investors want that sage, wise person to come and talk to their board, and they pay for it.
Right. So
It's not going away.
At Wharton and Chicago, we generally recognize that preferences matter. What you're saying is that a couple preferences are key. Well, one is for human interaction, but also one is for lower fees. And so maybe that's really another way of restating the question.
What I'm really trying to understand is, I know you guys deal with Vanguard all the time because they're just a gorilla and everyone's got to deal with them. And now they got their 30-bit human advisor. Like, that's kind of scary for the world of financial services. So I'm just wondering how you guys think about that challenge that they present to everyone.
Well, if you're an advisor, you better deliver something that you're not getting for 30 basis points at Vanguard.
That's why I'm wondering, are you guys still relying on them? Because a lot of them I feel maybe don't provide that value proposition. So at what point do you start saying, hey, we're just going to do that value proposition?
So are you, and is the industry, from your perspective, going to continue to rely on the human interaction, the human element, or will there be some bionic combination that you see in the future, or will, in particular, maybe millennials, that sort of seems to be where this whole conversation
We don't do
going,
distribution. We come up with ideas, and if a large institutional investor wants to invest, we introduce them to Robert over here.
Yeah, we trade the Rafi index, so, you know.
So I would say two things. One is I'm not sure that anything in smart beta is really impacting this question very much. So I think the existence of low-cost ETFs maybe has already had an impact. This is probably more of a second-order effect. I do think that I mean, BlackRock believes, in all of these channels, and sort of we support all of them, and we deal with all of them. We bought Future Advisor, but we deal with lots of, everyone. I would say I think robo-advisors are in the early stages now, but I do think if you think about millennials, I think actually many of them prefer to deal with computers than to deal with humans on some of these issues. And right now, of course, they don't have any money. So, in the aggregate, it doesn't matter.
But has 3 million years of human experience evolved us to an app?
Well, in some cases, now I may be biased by living in San Francisco, but it seems like everything has been app.
Everything's been appified. Okay, all right, so I think the answer is depends, but maybe.
Well, I think it's broader than just investment advice, right? There's going to be automation across all elements of the economy.
Right, so,
and,
so what about financial planning? And what about serious know your client algorithms and serious ability to deliver education on smart beta, which is a lot more challenging to explain than I would say, in some cases, even the notion of alpha.
My experience, and I'm not my business is not advising individuals, but my experience with interacting with those who that is their business, it isn't explaining smart beta to the end investor that they're doing. They're providing more of a interpersonal hand-holding
walk them off the ledge in 2008 or 2009, help them talk about intergenerational planning, and that means having the difficult conversation with your uncomfortable relatives. That's going to be difficult for a robo-advisor.
Although, I think if I had a robo-advisor, I might have them deal with my most difficult relatives. The truth. We have time for one more question before we wrap.
How do you determine when smart beta strategies are crowded? And in particularly, if you're going to say, well, you look at valuation, that would suggest that, something like a CAPE ratio would be useful for timing when it doesn't appear to be for individual factors or for the market. And in terms of talking about correlation between different smart beta strategies, isn't it very different to think about normal time correlations, particularly when there was not a lot of activity in these strategies, and what would occur in a meltdown period like the first 9 days of August in 2007 when the correlations were generated just by the trades being liquidated by overly levered quantitative hedge funds?
So Rob's already mentioned, looking at valuations of different of these factors is one way of judging. Just that people are paying up for this, and it seems to be crowded. We can look at trading data as well to try to understand what are the flows, and of course we have in ETFs we have a lot of data on flows into these strategies. So I think there are a number of ways of trying to judge. Looking at valuation ratios, while it gives you a sense that something is getting overpriced, it's very hard to predict when that's actually going to turn around. And if you've ever tried to time value, it's like, well, everything is overpriced, but it can get more overpriced, it can stay overpriced. It's sometime in the next few years, things will correct, but it's very hard to know when. So I think that's a challenge. I think the issue we saw in August 2007 was really high correlations driven by flows. And I think of strategies we combined where we would look at value in Europe, value in the US, value in Japan, and up to that point looked pretty uncorrelated, and you'd think it's hard to understand exactly why they should be correlated, but they were really correlated over that period because the same people invested in all of them, and there was just too much money in all those strategies, and it all came out at the same time.
We ought to worry more about the events in 2008 than in 2007. To some extent, August of 2007 should have been a warning bell for prudential regulators to be paying closer attention to the plumbing in the financial system. But I just think we ought to be doing much more. We've undone, or I think the law is in place to undo this silly expectation that you can invest in a money market fund that invests in risky securities and you'll never lose any money. But we still perpetuate the idea that you can be invested in an emerging market equity fund and get next day liquidity on your securities. There's work to be done to take this risk out of our financial system.
I just read a report by Deutsche Bank, which was like 80 pages long on crowding, and they found all these different ways of measuring crowding, and in the end, they determined that usually when there's a crowding event, the actual strategy still outperforms for the next 6 months. So, but over the long term, it will actually turn around. So it is difficult to use crowding as a way to time it, because you might be off by about 6 months to a year. So.
What are the going forward the largest, maybe holding crowding constant, but what are the biggest challenges that we're going to face either in smart beta, factor investing, active alpha? Give us a bit of a forecast. What are the biggest challenges? Okay, let's start with Rob.
Well, I mean, the strategies do have higher tracking error. Investors have to realize that sometimes a strategy can underperform for many years. Value has underperformed for, up to this year, has underperformed for the last few years. So clients have to be patient. They have to understand there is going to be tracking error. And that's the biggest concern for a smart beta fund.
Okay. Investor absorption of the idea of tracking, which is really, in some sense, the point, right?
I would say, the dispersion phenomenon I mentioned before, but I think more broadly for active management, I think the real challenge is going to be that you can no longer deliver static exposures to smart beta factors and charge 2 and 20 for that, or active fees for that. And I think there's a class of managers who've done that, and I think they get disintermediated.
And apologize quite a bit.
Yeah.
Okay. Chris, last word of the day.
I remember a terrific conference series that I used to attend in the 1990s called the Berkeley Program in Finance. It doesn't exist anymore, but I was at a talk at one of the Berkeley Program in Finance delivered by Bill Sharp. And Bill Sharp kind of ended his talk by saying, all of you people in the room, you understand all of these concepts much better than your clients. And it's up to you if you want to use that information to help people or take advantage of them.
Well said, well said. And a perfect transition to the culmination of the day. It's called a smooth pasting condition. Please join me in thanking our esteemed panelists for their contributions today.